Welcome to our exam review. This is exam 2, so we will be taking a look at the breakdown that I have here for you. And again, I'm recording this so that I can post this for anybody who couldn't be here. So first of all, as you know, this will be done on my accounting lab. We will have 40 multiple choice questions, so 2.5 points apiece. You will access the exam by April the 11th. You need to have it completed by 11:59 that evening. So with the exam, it's open book, open notes. I also gave you a formula sheet in case you need it, although those formulas are also in the notes for you. So with the exam, you'll take it on my accounting lab, just like you've taken quizzes, so no surprises there. So let me go ahead through this breakdown, starting with chapter 19. If you have any questions we go through, please let me know. So chapter 19, excuse me, which is about activity-based costing, just-in-time inventory, and also quality. So first of all is to calculate the overhead allocation rate under ABC, or activity-based costing. With ABC, we did spend time calculating the overhead allocation rate for each activity, in which we take that activity's overhead cost pool and we divide by the budgeted cost driver, whatever that may be, such as number of parts. So I don't have a whiteboard here at home to show you, but it will be just like the example that we had in class. So since I don't have a whiteboard, if you go back over the examples we had in class and the solutions, you should be fine. And again, please ask me any questions if you have any. Then the next, ABC versus traditional plant-wide overhead allocation. Well, ABC divides the one big plant-wide overhead cost pool into those for separate activities, and each activity has its own cost driver or overhead allocation base. So we refine our overhead allocation more under ABC. Then the next one is to pick out the relevant activity under activity-based costing, such as number of parts for assembly, such as machine hours for some machining activity, such as stamping out metal parts, something of that nature. So it'll be obvious which one is a good activity for you. Then calculate the overhead cost per cost driver under ABC. Again, that's very similar to the first one. Take the total overhead cost pool for the activity and divide by the activity's cost driver. You'll be given both numbers in the problem, and that formula will be on the formula sheet for you in case you need it. Then how ABC refines product costing. Again, that is with overhead. So each activity has its own overhead cost pool, its own cost driver or allocation base, which is more likely to be closely correlated with that overhead cost pool for the activity. So hopefully in the end, we more closely reflect resource consumption when it comes to overhead for the activity. Then shifting to just in time, the basics of it. So just in time, we know that everything starts with end customer demand. Everything else is subordinated to that in the way of timing. We will also be trying to save money in the spirit of lean manufacturing. So we will buy, for example, on the other end of the assembly line, direct materials from our supplier just in time to use them. So we tend to have lower inventory levels. We tend to place a lot more orders with our suppliers for material, and those orders tend to involve a smaller quantity of material. Also, we frequently have a smaller factory floor and storage area because we just don't need as much floor space with little inventory. Then quality basics. With quality, again, we're thinking lean, we're trying to save money. And I would like for you to know those categories of quality activities, such as prevention costs, appraisal costs, internal failure costs, external failure costs, which are potentially the highest, by the way. So let me ask, does anybody have any questions so far? If you would just let me know orally, please. Because on my current screen,
I'm doing good so far.
Okay, thanks. I can't easily get the chat feature, unfortunately, so if you would just let me know orally. I will have time at the end, of course, if you have any questions too. Okay, so as I move on down the breakdown here, looking at chapter 20, examples of variable and fixed costs. Well, chapter 20 does get into cost, volume, profit analysis. So we're looking at what happens as volume changes. As volume or number of units will change, we know that, first of all, at the top part of the income statement, sales revenue will change. Then total variable cost will change. Fixed cost will not change, but profit will change. So we go over variable and fixed costs. I will give you some examples of each. Pick out which is variable, or in other words, what changes as volume changes, and pick out what's fixed, what doesn't change as volume changes. Then, along with that, the next two will be to calculate total variable cost, total fixed cost. So given some various costs there, pick out the ones which are variable and add them up. Pick out the ones which are fixed, add them up. Then characteristics of the relevant range. We always assume that we're within the relevant range because that's where the normal cost, volume, profit relationships that we expect will come true. If we get outside the relevant range, such as if our relevant range is 5,000 to 15,000 units that we can produce, that means within the short run or within 1 year, there is the minimum, there is the maximum. If we get outside that range of production, then we don't have the usual variable and fixed cost relationships. So variable cost per unit could change, total fixed cost could change. We don't want that, so we stay within the relevant range. Then calculations under the high-low method. This will be very similar to the example in class, so do go back over it. So from the high-low method, we calculate an equation for total cost. Then once we have that equation, we can substitute in any number of units we would like. And I will do that. I will want you to calculate the total cost equation. Then I will give you a number of units, substitute that in, and calculate the total cost at that unit level. Then to calculate the contribution margin ratio, we know that that equals contribution margin divided by sales revenue. So this is the proportion of sales revenue left over once we've covered variable costs. It gets its name because it will provide toward contributing to cover fixed costs and then contribute toward providing for a profit. Then, 2 on calculating the break-even point. 1 units, 1 sales dollars. You have the formulas for you. These will be just like we did in class. Also in the previous one, contribution margin ratio, just like we did in class, and you have the formula. Then to identify points and lines on graphs. So I will give you a graph. Identify a point such as the break-even point. Identify lines such as total revenue, total variable cost, total fixed cost. So chapter 20, do you have any questions there? Anything that I can clarify for you? Again, if you would please let me know orally.
Nope. Making sense.
Okay. Thank you, Tyler. I think that was your voice.
It was me, CJ.
I have kind of a truncated view of everybody here on the right side of my screen. If I enlarge that, then it's going to stop sharing my screen. So that's why I'm not going over the chat function for the moment. Anything else on chapter 20? Right? Chapter 22, it's about budgeting. So budgeting basics. Well, we know the budget is simply a company's plans quantified in dollar terms and or in units. So it's a really good means of communication to everybody, and then we can come back later on, compare actual performance to budget, and see if there's any difference, any variance. Sales budget characteristics. With the sales budget, that's the starting point for all their budgets, because everything else in the company should support sales. So we do the sales budget first, then the others. The next is calculate total budgeted sales. You'll be given units, you'll be given the price, multiply the two. It's that simple. Then calculate budget production. So budget production is what is going to support the budget sales level. So it's based on beginning inventory of finished units and our target or desired ending inventory of finished units. So you'll calculate budget production, again, just like we did in class. If you have any questions on that or anything, you know to let me know. Then characteristics of direct materials purchases budget. Well, once we know budget production, we can step back and think about how many units of direct materials we must purchase to make that budget happen. So with that direct materials budget, again, it will be very, very similar to what we had in class, leading into the next one to calculate the budget purchase of direct materials. So that will be just like we calculated in class. Not difficult, and people tend to do quite well in budgeting material in general, by the way, as well as the other material on the exam. So it's not a bad amount of material, and certainly in terms of the quality of material, it's quite understandable for the most part, I think. So that's why people do well. Then calculate budget direct labor cost. You'll be given the hours of direct labor and the direct labor cost per unit. Multiply the two. Then characteristics of selling and administrative expense budget. So those are the non-manufacturing costs. We must have variable selling and administrative separate from fixed selling and administrative, which leads into the next question. To calculate budget selling and administrative expenses, for variable, you'll be given variable cost per unit, and you'll be given unit volume. Multiply the cost by the number of units. Then for fixed, you'll be given the amount of fixed directly. Add that to the variable that you calculated, and that will be your correct answer. So that one's easy. Then the next two are about cash. To calculate budget cash payments, in other words, what we're going to pay to others, and then calculate budget cash collections, what we expect to collect from customers. So we had examples of those two in class. And for these questions on the exam, these are actually easier than those examples. So if you get through those examples, you're more than prepared for these two questions on the exam. Of course, on the exam, you can go back and take a look at things since it is open book, open notes, but you just want to be prepared so that you don't have to spend much time doing that. Any questions on chapter 22? Again, if you would please ask orally.
Sounds good.
Sounds good. Thank you, Tyler. I think that was you, Tyler. Okay.
We're all set here.
Good. All righty. So for those of you watching this by recording, I'm going to go ahead and stop there. Again, please contact me with any questions. Thank you.
Thank you.
And for those of you live, I can come back and answer any questions you've got here in just a